Hello students, I am Sukhdeep Sondhi, Assistant Professor from the Department of BCom Bank Management. Today my topic is going to be Banking Regulation Act 1949 and RBI. So let us learn what is Banking Regulation Act and what is RBI. If you see the definition, the Banking Regulation Act 1949 is a legislation in India that regulates all the banking firms in India. Earlier it was known as the Banking Companies Act, but later it was changed to Banking Regulations Act 1949, and on which date it came into force? 1st March 1966. It is applicable in Jammu and Kashmir from 1956 as well. So what does the Banking Regulation Act 1949 does? The major task is to assign powers to the Central Bank of India. Which is the Central Bank of India? That is nothing but RBI, the Reserve Bank of India. The Banking Regulation Act 1949 gives power to the RBI in appointing the board members and regulating the full management, controlling the day-to-day operations of all the commercial banks, giving the interest of social benefit and various other functions. Before we move on, let us know one simple definition of bank. In simpler words, bank is nothing but a financial institution that regulates the day-to-day activities such as accepting the deposits, controlling the withdrawal, and giving services to the general public. What do you mean by licensing? Is it something which is written on the back of your car or vehicle? No. Licensing in banking is nothing but a certificate that a particular bank has met all the legal requirements when it comes to protecting the customer's money and the data. Licensing is nothing but official authorization from the superior authority that yes, you can operate a bank in the particular area for the services to the customers. So let us see what are the basic functions of bank, which as an Indian, as an account holder, all of you must know that why you all are going to banks. There are two major functions of bank, primary and secondary functions. Under primary, we are accepting deposits, we are granting loan and advances to the customers so that they can fulfill their financial criteria. Under secondary, we are acting as an agency and we are having a lot of utility functions. The Reserve Bank of India, if you see the history of RBI, it was set up on the basis of recommendation of Hilton Young Commission. That is nothing but an enquiry commission used during the British era to make sure that all the union territories are coming together. The Reserve Bank of India Act 1934 provides a statutory basis of the functioning of the bank, which commenced operation on April 1st, 1935. Why the bank was made? Number 1, to regulate the issue of the bank notes. Number 2, to maintain the reserves in cases of emergency and to ensure we are having a monetary stability. And number 3, to operate the credit functions of the various areas. Next, if you can see in this slide, I am having one small camel at the left. What does the camel mean? The answer you will get in the last points of the slide. The Annual Financial Inspection AFI focuses on areas of solvency, liquidity and operational health of the bank. RBI conducts the AFI every year. Annual Financial Inspection is based on the internationally adopted model otherwise known as CAMEL. What is CAMEL? C for capital adequacy, A for asset quality, M for management, E for earning and L for liquidity and system and control. Now RBI focuses on lot of big functions, but there are two major functions which are very important for RBI to regulate the monetary supplies and the monetary policies of any country or our India. There are two major functions, number 1 being role of RBI in controlling credit in India. What do you mean by credit? It is something you give to anybody as an advance. Later you want that money back. Fine. So the first and foremost function is controlling credit. The RBI as the country's central bank takes the actions to keep the credit under the control. So what does all of us mean by controlling the credit? Every bank should know how much to give to any other person who is demanding the money. As per our income, we are given the loans or the other services which bank is providing us. If you are earning a monthly income of 10,000, bank cannot give you more than 5 or 6 lakh. If you are earning more than 10 crore per year, then definitely bank can give you in 15 to 20 crore range. This is how the controlling credit system works in India. Every person is given loan based on the amount you are earning, based on your capability, based on how much you can pay back to the bank. RBI should ensure that not every person can get the credit just like that. Credit should only be given to the person who are capable of paying back to the bank. The second and most important function of RBI is credit creation. Earlier we have seen how are we going to create the credit, how the customers are going to demand the loan and how much we are going to give it to the customers. The next very important point is how are we going to create the credit, how are we going to fulfill the demand of the customers who are coming to us daily. Imagine all the customers going to the bank and asking to give the money right now. What will be the scenario? It will be a very poor one, right? That's why banks are having credit creation. That means for every demand which any new customer or the existing customer brings, bank should be able to fulfill that on the spot, but definitely within a certain limit. That's why every day you are having certain limit to withdraw in the ATM. You cannot withdraw 1 or 2 lakhs continuously at one day. RBI is having a certain maximum denomination beyond which you should not be able to withdraw. The two most important aspects of credit creation are nothing but liquidity and profitability. What do you mean by the term liquidity? The banks must pay cash to the depositors whenever they exercise the rights to demand cash against the deposit. What do we mean by the profitability? Banks are meant for the profit. Therefore, a bank must grant loan in a manner which earns higher interest than what it pays on the deposits. Also, the bank assumes that all the customers would not turn up demanding cash against the deposits at one time. So this is how the bank is creating the credit. You go for the loan, you apply for the loan. In return of the principal amount, you are going to pay certain interest to the bank. That interest will serve as the credit creation process. So these are the two very important functions of RBI, credit creation and controlling the credit. So these are the two very important functions of RBI, controlling the credit and creating the credit, which will ensure that the Indian economy is stable and all the monetary policies are going to the best. Thank you to everybody.